from Barangaroo Studios, the ausbiz COB is the key stuff you need to know about the day in business and finance.
Welcome to the COB this Tuesday. I'm Juliette Sarli.
And I'm Andrew Gagan. Yeah, great to be here at the end of the day. A little unusual for me, but it's a good way to get across, of course, where we're at the second day of the trading week, and looks as though we're sort of finishing on a negative note.
Yeah, look, you had CBA, of course, hitting a record, but then you've got the big names like Coles, Wesfarmers, Woolies, all ex-dividend as well. So that kind of really took a bit of a play on the market. Let's see where the SIBO is. I think you mentioned that it's going in a bit of a different direction to the ASX 200.
Yeah, indeed. So we're up about a tenth here on the SIBO 200. So we were just talking about this prior to coming on about the weighting of this, because we take a look at the ASX 200. It's actually off about 1/10 of a percent.
Yep, and that is mainly because of this dividend drag. You have the big players that I mentioned, Coles, Woolworths, Wesfarmers, all trading without rights to their dividends today. Wesfarmers certainly not finishing the day as negatively as it was. It's now down 1.6%, but it had a big drop on the open. Woolies, though, down by 3%, Coles off by 2.5%. So when you see that coupled with weakness in the material sector, mineral resources, another big drag today.
Yeah, in fact, I was saying that earlier. We've got the tail of two sectors there, the two largest sectors, certainly on the ASX, and materials off substantially today. Obviously, the iron ore miners, also the lithium miners coming off hard today as well. Whereas the financials, led by the big banks, doing again very well, led by the likes of CBA.
Yeah, another record high. It is quite incredible. I mean, this is a stock that many analysts didn't think would hold above 130. Then they sort of changed that to 135. Now $143.23 is where CBA sits. You got to think maybe people are buying in ahead of its dividend payout as well.
We shall see how that transpires once we get to that point.
Yeah.
Also, the deficit doubling. And okay, this comes ahead, of course, the GDP read tomorrow, so it's going to be fascinating to get a good read on the local economy. Hearing plenty at the moment from the Treasurer, Jim Chalmers, who's getting in ahead of the game, isn't he, saying it's going to be weak.
Yeah, absolutely.
And you can look at those guys over there, the RBA.
Well, Paul Bloxham, I think, said similar to you from HSBC. But what was interesting was that we saw lower coal and iron ore prices impact terms of trade. But on the services side, you had the influx of students, tourists, and a lift in spending by non-residents. So tourists helping somewhat. But as you say, a deficit for the second quarter, mainly due to that weakness in export prices. All right, let's have a look at the sectors of the day. Kicking it off with those consumer players, as we saw Woolies and Coles trade ex-div. And bigger, I think, too, wasn't it? And Endeavour.
It was, yes. So they've all come off as a result. In the mining space, as we were mentioning there, quite weak across the board at this point, led by the likes of Fortescue, which is down 2.5%. And
CBA, as we mentioned, hitting a record. Looking at the other banks today, they're all looking very positive. Macquarie Group, $220.
Now, in terms of the top stories today, shopping centre operator Scentre Group poised to raise $750 million, targeting bond funds and wealthy individuals with attractive returns from a potential hybrid investment deal.
We also were watching the microbiome health company Biome, updating quarter one sales revenue expected to surpass $4 million, and that would be a record, setting its shares up 12.5% today.
Email Payments, the prepaid cards company, well, let's just catching up with that. It's offloading a business, in fact, and that's the completion of a sale of its Sentenial unit for $53 million plus to Go Cartus.
And Singapore-based agribusiness Olam extending its off-market takeover to acquire all of the shares in Nimoy Cotton. Nimoy did not really trade today, 68 cents. All right, let's get to our guest. Scott Phillips from the Motley Fool joins us. Scott, all that money being paid out in dividends, where's it going to end up?
Juliet, Andrew, good afternoon. I wish I knew, because I get ahead of that trade if I did. It'd be fascinating to find out, guys, because you set it up beautifully. We've got obviously a lot of cash hitting bank accounts at the same time. Not yet, by the way, it's ex-dividend today. But at the same time, we've got some real economic uncertainty and some real concerns as to what might be next for the Australian economy, let alone the world economy. In market-wise, a good question. I would suspect some of the money come from some of those retailers in particular, probably going to go back into the biggest and bluest chips of the country, almost by definition, right? If you hold those stocks, you're either going to spend the money, and a lot of Woolies, Wesfarmers, Coles shareholders probably are investing for, if not for the income, at least taking the income, maybe a lot of retirees and superannuants. On the flip side, some of it, of course, will go back into the market probably, again, because of the style of companies we're talking about, largely back into that place. What the fundies do with the cash is an interesting story as well. I'll have to wait and see how that changes markets. It is a reminder, though, you guys have said this before, but it's worth reminding our viewers, when we see the All Ords, the ASX 200 or the SIBO, these numbers, the indices we look at, don't include dividends. They never have. And so we look at the market performance, even when we say we're getting close to highs, for example, we are well and truly at or above record levels, more often than not, because when you add those dividends back, the market climbs higher.
Yeah, so Scott, you talk about maybe some of that being reinvested into those blue chip stocks. CBA, my goodness, It just, look, every time we talk about this, it goes higher and higher.
It's extraordinary too, Matt. When you think about the circumstances for the Commonwealth Bank, you think about the circumstances for all big four banks. Some numbers out today, by the way, talking about Macquarie's loan growth at 5 times the growth of some of the other big banks. The dollar value of Macquarie's loan growth almost catching CBA. I don't know, mate. I've long watched CBA's share price rise to and at reasonably, I think, unsupportable valuations. Can I say that? I'll probably annoy some of our viewers by doing so. These are really, really expensive valuations for CBA. And in a time when the banks are struggling for growth, I mean, that they are either flat or down at the top line, flat or down on the bottom line, trying to cut costs as fast as they dare, given political pressure around branches, given concerns about the pace of growth of the mortgage market, the corporate debt market as well. A lot of money flowing to private credit, by the way, which is a whole other topic we might talk about another time. But I don't know how you pay this price for CBA. I really don't. A lot has to go right, or you have to simply hope everyone else continues to pay too much for the shares to justify today's share price.
Yeah, it's extraordinary when you look at it compared to ANZ and NAB, isn't it? 3 times? Okay, let's talk about the iron ore price as well. When we're looking at just a lot sitting on China docks.
Yeah, and this is a real challenge right across the board, right? Think about our market dominated by the banks we just talked about and the miners, and most of that is iron ore profits. So really important there, really important for jobs, incredibly important for the federal budget and the size of the surplus or the deficit there as well. So what's, for most of us on the East Coast or on the Eastern Seaboard, not something we see and think about every day. Certainly for investors, if you're in that space, you think about it every day. But it's a really, really big one. And Chinese demand remains the swing factor here. We've heard from Chinese steelmakers saying, you know what, we might not need as much. We know there's some, as you said, sitting on the docks. And we know China's, by the way, also desperately trying to find other places, particularly Africa, to mine iron ore for their uses at the same time as China's infrastructure boom is not coming to an end necessarily, but you got to figure they're turning the wick down on that growth story. So it's a really, really fascinating time for, as I said, all of those. The Australian economy, for the share prices of the companies, and of course the federal budget. Take that away from any of those circumstances. Take it out of the ASX, take it out of the federal government, take it out of employment, and all of a sudden you've got some really significant challenges, particularly at a time when they've shut down nickel operations, for example, in WA. Again, I'm not going to forecast commodity prices. It's a mug's game, but you think about the risk to those parts of our economy versus the upside incrementally, not a lot left. There's only kind of downside to go. So one of those, cross our fingers and hope the lucky country epithet continues to apply.
Well, Scott, you mentioned the economy. We're going to get that quarterly read on growth tomorrow, expected to be on the weak side, of course. What are you seeing there? What are your observations about where the economy is tracking? Now, obviously, because there's no interest rate cuts in sight at the moment, and this is the dilemma, isn't it? And obviously frustrating the government.
Really difficult across the board, mate. So let's start with the economy. We know GDP growth was only 0.2% last quarter. We know last week's retail sales numbers were dead flat, and that included growth of 0.2% in food. Now, you've got to figure we're all going to eat, right? So take that out of it. Everything other than food was down, and down pretty significantly, given how important food is as a component of retail spending. So that's kind of where we are. The trade deficit today was a really ugly number. It will detract meaningfully from GDP growth. Forecasts will vary. I won't be at all surprised if tomorrow's a negative number. I don't want to be negative Nancy, but I'm going to be, given that drag, particularly from that export number. And also, you kind of mentioned it in the intro, when the Treasurer is out there so loudly and repeatedly saying, hey, everybody, it's going to be ordinary, I've got to figure they believe there's a decent chance it's negative. Now, we've been in a per capita recession for 7 quarters. So at an economy-wide level, on a per-person basis, we're already in a bit of trouble. The risk, of course, if we go negative at a total economy level, is it impacts business revenues, business profits, and that impacts employment. We've been kept afloat for effectively the length of the post-COVID slowdown because unemployment has stayed really, really low. Even though it jumped up last month, we still created 60,000 jobs. So it's an extraordinary story for economic growth for the country. But given the retail numbers, given the trade numbers today, I do think we might be on our skates if we're not careful. So a bit to go there. What does it mean for the economy? The big one, Matt, is the confidence factor. As much as we're all in a per capita recession, while we avoid the capital R word on the front page of the papers, increasingly virtual front pages, but anyway, it becomes a self-fulfilling prophecy, right? Once you know you're in recession, you freak out. I might lose my job. So what do? You stop spending. When you stop spending, businesses stop getting revenues. They stop hiring. You tend to create the circumstances you actually fear. In both directions, by the way, we also create recoveries when things feel good and we feel better about the future. So the big concern at an economic level, at an unemployment level, is that a capital R recession, if tomorrow is negative, and again, I don't want to say I'm forecasting, I'm just holding out the possibility, that if it's followed by another quarter, could be really, really bad news for the economy. Bad news for company profits, of course. The US cutting rates hopefully will stimulate a bit of global growth because we are still very, very reliant on the global growth story. If that can remain positive, that gives us something to cling on to, see if we can keep out of the negative numbers.
Well, you better stop talking about it, Scott. You're sounding too negative.
Yeah.
Sorry, mate. Look, I'm an optimist by nature, mate. I'd love to believe tomorrow will be really, really good. I'm just concerned if you put these numbers together, the retail sales, the treasurer's talk, everything else is going on.
Yep.
I don't know. If you're framing a market, you'd say the odds, unfortunately, are better than they have been for a while. I hope that's not true, but we should be prepared for that to be the outcome.
All right, Scott, thank you. As always, Scott Phillips there from the Motley Fool. Now, when it comes to the stock of the day today, do you remember what that was? Cast your mind back.
Well, yeah, in fact, we were just talking about this too. Obviously, iron ore price is such a key component just as far as our exports are concerned. Fortescue being one of the key ones there. It was our stock of the day, reviewed by Ben Clark and Sean Hickman.
I wouldn't buy Fortescue, but I would nibble away at BHP because just, basically on what you said there. I think there's this growing sense of a bit of gloom around China, and everyone you speak to that's been to China recently will tell you that it's fairly grim. And we saw not just from the resource stocks, but from companies like A2 Milk and some of the other businesses that are exposed to China, that there are real pressures on the country at the moment, and on the steel price and the iron ore price as a result.
A lot of moving parts. In summary, I regard Fortescue as a hold. It's not the way I'd play the space.
Right. So you wouldn't be buying in, saying this is the bottom of the iron ore cycle?
We own Fortescue in our income portfolio. I should clarify that. And if I didn't have, or we didn't have a position, I think Fortescue will give a good yield around these prices for the next few years.
So that was Ben Clark from TMS Capital and Sean Hickman from Market Matters. All right, so Juliet, let's take a look at the winners and losers in today's trade.
Yeah, Kelsian Group there had a good day, up 7%. Nanosonics, either you or Nadine spoke to them yesterday. I'm thinking, Nadine, looking at your face.
That's a long time ago.
Lovisa rose by 4%, and Polynovo had a good day as well.
All right, on the negative side of the ledger, let's take a look. Mineral Resources, has been hit hard again. Certainly hearing from Chris Ellison, the boss there, he is very negative. This seems to be reflected in the share price at the moment. Also, those lithium miners, Liontown, among them, are down today as well.
All right, in the small end of town, Energy Resources, oh my goodness, 172%, but that stock is worth 1 cent, so it must have been worth half a cent before that. Omni Bridgeway up by 14%. Lindian Resources, Biome, we talked about that coming through with some numbers, in SKS Tech as well.
Negative ones there, Titomic, it is down at 17%, and Terracom, also of note there, off some almost 15%. Big Tin Can, we just spoke to them last week, and that's down more than 9%. And
that was you, I remember. All right, let's have a look at what is happening tonight. The ISM Manufacturing Index for August in the US, and construction spending, always a good read. On the overall economy, of course, we're just really eagerly awaiting non-farm payrolls, but Wall Street had a long weekend as well, so playing catch up to what happened in Europe, I guess, as well.
All right, and tomorrow we'll locally, as we've been talking about, the read on the quarterly read on economic growth here locally, and also get the China Occasion Services Index too.
All right, let's have a look at where the CBO is. We mentioned potentially going in a different direction from the ASX 200 because of its different weighting. So it's finished up by 0.1%, while the ex-dividend drags on the ASX 200 has seen it close just slightly down 6 points there, 8,103, so above 8,100 points.
Look, should we call it a flat?
Yeah,
ending?
we'll call it flat.
Yeah. All right,
Flat
split-
as a
split the
pancake.
difference.
It is a Tuesday after all.
Yeah,
Shrove
all right.
Tuesday, not quite. All right, on that note,
Yeah, we'll do it again tomorrow.
see you then.
See ya.